governments and policymakers to ensure that no segment of society is left behind in participating and benefiting from a nation's development. But what of the role of the financial services industry? It is worth noting that 14 out of the 17 SDGs include specific targets that focus at some level on the financial sector. Let me just mention a few. On poverty, the SDGs include a specific target to build resilience of the poor and those in vulnerable situations. On hunger, targets include doubling productivity and incomes of small-scale food producers through secure and equal access to financial services. On health and well-being, the targets provide that we should ensure universal health coverage, including financial risk protection. On education, ensure all youth and a substantial proportion of adults achieve literacy and numeracy. On decent work and economic growth, encourage the formalization and growth of micro and small and medium enterprises, including through access to financial services. On industry, innovation and infrastructure, increase access of small-scale industrial enterprises to financial services. And of particular interest to this forum, on inequality, reduce the transaction cost of migrant remittances to less than 3% and eliminate remittance corridors with costs higher than 5%. The list goes on. Yet based on a recent survey report by GlobeScan, only 1/3 of private sector respondents reflected on SDGs in setting long-term sustainable strategies for their organizations. This should concern us. In 2015, 15 years after the Millennium Development Goals were adopted, the United Nations itself conceded that the MDGs, despite propelling significant progress, fell short for many people. So a different approach was taken for the SDGs, one that was more encompassing and inclusive. 5 million people from 88 countries shared their deepest, most pressing concerns and aspirations to create the SDGs. These aspirations would ring hollow without the dedication and commitment of those with the influence and the position to make a difference. For the financial sector, this needs to go beyond the cursory initiatives that have generally been associated with corporate social responsibilities. Greater progress by financial institutions to more fully embrace sustainable principles in their business strategies will play an important catalytic role in delivering the SDGs. Among other things, it would provide a stronger focus on needs-based selling, increase financial resources that are directed at economic activities that promote sustainable goals, and encourage support for businesses to adopt sustainable practices. Turning more specifically to remittances, which is the focus of this forum, more can and should be done to amplify the development impact of remittances, as Ceyla has already mentioned. In its report, Sending Money Home, IFAD estimates that about 1 billion people, migrants, and their families send and receive remittances. This translates to 1 in 7 people in the world. The most dynamic growth in remittances over the past decade has been in Asia, which receives 55% of all flows. In some countries, remittances equal more than 20% of GDP. These statistics underscore the profound impact of remittances on development. For most migrants, the prospect of dealing with banks remains generally daunting. Non-bank remittance service providers or money transfer operators, on the other hand, are trusted by migrants and a regular point of contact to send and receive money. This places them in a strategic position to evolve from narrow service providers to change agents for entire communities by providing financial education and solutions that can help pull families out of poverty traps. For example, RSPs can partner with financial institutions in sending and recipient countries to create savings, insurance, and investment products that are linked to migrant remittances. Some developing countries with large diaspora groups have successfully issued diaspora bonds, where the bond proceeds have been channeled to finance development projects in their home countries. Other innovations can surely be developed to more effectively leverage migrant resources for development. There is certainly no shortage of creativity and innovation in financial services. Regrettably, the global financial crisis will remain a dark period of history where such creative forces were misdirected with dire consequences for growth and development. We must ensure that this never happens again. But that should not discourage us from harnessing and redirecting such creative forces to address today's most urgent global challenges, and in the process, restore trust and confidence in the financial industry. This brings me to the role of policy. In recent years, global standard setters, including the Basel Committee on Banking Supervision, the Insurance Association of Insurance Supervisors, and the Financial Action Task Force, have heeded the call to promote a better balance between objectives of financial stability, financial integrity, and financial inclusion. This has resulted in important strides taken to encourage more proportionate regulation. Despite this, a recent report by the Financial Stability Board disclosed that as of 2017, the de-risking phenomenon continued at the global level, affecting remittance service providers in many poor countries that rely on remittances from abroad. Clarifying regulatory standards is an important step, but clearly this alone is not enough. So where to from here? Well, first, taking a cue from Albert Einstein, who famously said that we cannot solve our problems with the same thinking we used when we created them, there is a need for policymakers to create safe harbors for experimentation. A number of regulators have introduced regulatory sandboxes that have helped create a virtuous cycle of innovation and sensible regulation while isolating risks. In Malaysia, solutions tested in the bank's regulatory sandbox enabled us to design regulatory safeguards that would allow the implementation of end-to-end electronic Know Your Customer processes for the provision of remittance services. By dispensing with the need to conduct physical face-to-face verifications, this is expected to significantly expand access to remittance services for customers working and living in remote parts of Malaysia, while effectively addressing money laundering and terrorist financing risks. Bank Negara also successfully collaborated with the World Bank and the money services business industry in Malaysia to pilot and adopt solutions that have expanded the reach and reduced the costs of formal remittances. Second, policy life cycles will need to be managed more proactively to allow for policies to be renewed when conditions change. While much is often said about policy stability, policies that fail to keep pace with conditions that are changing far more rapidly than we have experienced before can be counterproductive at best and at worst create greater risks for the system. The SDGs are undeniably one of the most comprehensive attempts to capture the most important global challenges that we face. Solutions to these challenges will invariably create new issues for policymakers to consider. This in turn will lead, in our view, to shorter policy cycles and a need for faster policy responses to emerging issues. Third, we need better remittance data. It is encouraging that efforts are being taken to ensure the availability of official global data sources on remittance flows. Yet challenges remain in ensuring that the data is both complete and comparable. These challenges are compounded by an increasing need for data at a more granular and disaggregated level. For example, initiatives by the United Nations Capital Development Fund to survey remittance recipients in the Mekong region helped develop a better understanding of relationships between gender and financial inclusion. Yet such data is not available in many countries. With the large and increasing size of intra-regional migration in this region, there are opportunities to collect and share remittance and migration data at the regional level to complement global data sets. This could be advanced through existing regional forums, including various forums at the ASEAN level. Without good data, we cannot hope to move very far or with much confidence in efforts to increase the development impact of remittances. In summary, the notion of proportionate regulation has more than one dimension. It should not be mistaken for lighter regulation, nor should it be informed by considerations of size alone. The world is much more complex, and regulators will need to find creative ways to better understand and manage that complexity. This is really a paradigm shift in the way that regulation is traditionally approached, to one that is more iterative, more inclusive, and more discerning. Ladies and gentlemen, Eleanor Roosevelt once said that universal human rights begins in small places close to home, where every man, woman, and child seeks equal justice, opportunity, and dignity without discrimination. Remittances have significant potential to deliver such opportunities to millions of migrants in their home countries. Let this forum serve as a call to action based on an honest search for better understanding and a genuine commitment to pursue individual and collective actions. With much at stake, we really cannot afford not to. So I hope that you will have a very productive and interesting exchange in the coming days. Thank you very much for being here.